Welcome back. You're still with us on Markets Today. Well, let's run you through the rest of the headlines that we're tracking for you, which brings us to the fourth headline today. Just Dial was on close to 2% in trade after Reliance Retail Ventures announced plans to trim its holding in the company. Rima standing by to run us through all those details. Rima?
Thanks so much for that. So Just Dial's promoter Reliance Retail Ventures will be selling 2% stake in the company to achieve the minimum public shareholding requirement. The stake sale will happen in the open market. They are planning to complete the share sale within 8 days, beginning tomorrow, December 21st. As of 30th September, the Just Dial promoter entity held close to about 77% stake, which is why they're looking to sell 2% stake, so they come down to 75% to comply with the requirements. Now, the stock Just Dial has been down 20% in the last 1 year. It's currently hovering around 600, 610 rupees, and it's sharply lower than the time Reliance Retail Ventures had acquired the stake. In fact, Reliance Retail Ventures' open offer to acquire that incremental public 26% stake happened at a price of 1,022. So since that price, the stock has been a rank underperformer.
Got it, Rima. Thanks for that. Well, Sterling and Wilson, well, that as well was down close to 3% after the company's promoters decided to lower their stake to meet the SEBI norms. Vivek Iyer, he's standing by to run us through quick details on that front. Vivek?
The stock in focus is Sterling and Wilson Renewable. Now, a promoter as well as the promoter group entities are looking to offload a little over 5.2% stake in the company, and this will be happening via the OFS route or the offer for sale route. Now, two promoter entities. First entity that we're looking at is Shapurji Palanji Group. Now, they are looking to offload almost 3.69% stake in the company, with the base size at around 2.5% and the oversubscription option at 1.19%. Khurshid Daruwala, another promoter in the entity, is looking to sell close to 1.58% stake in the company, base issue size of a little over 1% and oversubscription option of 0.5%. Now, the floor price for this particular promoter OFS is at 270 rupees a share, and the main reason for this particular OFS, what is it and why is it that the promoter is paring stake in the company? This is mainly to meet the SEBI MPS or the SEBI minimum public shareholding norms. What we understand is that after this particular stake sale, the promoter will not be required to pare any further stake in the company because they will then be compliant with the SEBI norms.
Perfect. Thanks for that, Vivek. Well, moving on to the fifth headline today. Hindustan Global Solutions, that was down close to 3% after offering a buyback, at a hefty premium. This after the board, had close to around 1,000 crores in terms of a buyback. That's via the tender route itself. Rima stands by to run us through more details on that front. Rima?
Yesterday, the board met and they've approved a tender buyback of size 1,020 crore. The buyback size is a maximum of 1,700 rupees per share. So it is at a significant premium to where the stock is currently trading at. The cash on the books of Hindustan Global Solutions is also substantial, close to 1,672 crore as of 30th of September.
Got that, Rima. Well, Vivek's back with us to tell us about Jefferies. Well, they have exited Zomato, Bharti Airtel in their India model portfolio, according to a report from their equities strategy team. Vivek standing by to run us through all the changes that they have made. Vivek?
Well, that's right. Very interesting strategy note coming in. And what we are highlighting is, the kind of portfolio changes they've done as far as the model portfolio is concerned. So as the year winds down, they've made some tactical changes and, along with the rationale, they have highlighted the changes that they've made. So number one, recently Jefferies had raised quite a bit of cash as far as their India holdings was concerned. And they've now started deploying that particular cash into the metal sector. And also what they've done is they've shifted weight, from their holdings in Bharti, Zomato, as well as Maruti, and they have put this particular money into L&T, RIL, as well as the banking pack. Also, what they've done, they've gone ahead and added Tata Steel and Hindalco to the model portfolio, where because of that, the material sector rating has now gone to neutral from the current positioning that they had, which was nil. Also, what they've done, industrial sector is something that they like, so they've added weight to L&T, and now the industrial sector positioning has gone ahead and been increased to an overweight stance. They've added weight to RIL as well, And funding into metals has partly been done by removing cash from the portfolio, so deployed cash, as well as trimming their stake as far as Zomato is concerned. They've gone ahead and shaved or trimmed some stake and some weightage from Maruti, and this they've once again put it into banks. Also removed Bharti Airtel from the model portfolio. Now, looking at the rationale, number one, the additions that we mentioned earlier, metals, what they're saying is that the China reopening as well as the US rate peaking out is something that they believe can add further sentiment as far as positive sentiment as far as the metal space is concerned. L&T, they're seeing a pickup in the broader capex, and they also feel that order inflow here can be quite strong. RIL, what they believe is that the core, oil to chemicals business is something that will see increased business profitability, and petchem margins too will improve on the back of China reopening. On the other hand, some of the stocks where they have seen cuts, the rationale behind that, Zomato, they are incrementally wary, of potential rise in competitive activity in the sector. As far as Maruti is concerned, they see potential headwinds to discretionary consumption on the back of slower wage hikes as well as the IT sector weakness. And lastly, coming to Bharti Airtel, they are saying that concerns on rising 5G capex as well as the company not being able to raise tariffs as much as they would have liked is something that they believe bodes reasonably negative as far as Airtel is concerned.
Okay, moving on then. Meanwhile, Shipping Corp of India closed after, with some gains after the stock hit 52-week highs in today's trading session. Remember, they've come out with an update on the demerger process and also the increase in tanker rates. That's what's helped the stock do pretty well, but though it came off the high point of the day. Vaistha joins us for a quick analysis on that front. Vaistha?
Well, thanks for that. The big news why the stock is in focus today is because there is a divestment news on the stock which is coming in. The final hearing before the Ministry of Corporate Affairs for obtaining sanction on the demerger has been fixed on the 29th of December, and this is as per the directives of the MCA, which is issued during the hearing which was held on the 16th of December. There was a delay in the process though, which was due to a fake complaint which was filed in the name of a union earlier. So that is point number one. The second trigger in the stock is that the company largely operates in the tanker space, but there's a sharp increase in the tanker rates as currently, which have not yet been reflected very well into the results of the company. Also because the company operates on longer term contracts. So whenever there's a renegotiation of these contracts, the benefits would start flowing into the results. Anyways, the biggest stock for this trigger for the stock has been the demerger news. The stock has already rallied by about 60% in the past 6 months. So let's see how it moves again. Back to you.
Well, on that note, we'll have to wrap up on this edition of Markets Today. But before we leave, we have been speaking to market experts to get a sense of what Dalal Street could throw up in the new year. Here's what they had to say.
On valuations, we are starting at a fairly high point, right? Currently, the market rates at 20 times 1 year forward. So we do expect that multiple tapers off a little bit.
Rural demand might do better than urban demand next year. One of the key risks that we are highlighting is that the excess savings of the pandemic is almost coming to an end.
There's a little bit of weakness in the IT stocks because the market tends to be short-term oriented. Yes, there is a recession in the West, which is the large buyer base for the Indian IT service industry. There will be some slowdown in terms of top-line growth and deal flow.
If some of the trends that are there today, if they continue, then hopefully it will be a better year. As compared to the rather unprecedented levels of food inflation that we had in 2020.